So, once again, good evening, everyone, and welcome to all of you in this September series of webinars. My name is Yogesh, and today we are going to do a touch base on a very different topic. We started these sessions from financial literacy. We talked about investor psychology. We talked about yesterday European Central Bank decision, which was supposed to happen today. And if you have seen, markets have been really volatile. Gold have touched a new high today, 2,551. Oil prices have recovered slightly. We have seen euro slightly moving higher. And all of this proves that the nature of the market is very unpredictable, and that is the reason why we need to be aware and informed about the products which exist, and we need to understand that how these products function. Today I'm going to discuss about ETFs, or exchange traded funds, what they are, and then I'm going to take you through few ETFs which you can look into. And as I say that everything I'm going to discuss over here, it's for information purposes only. If you want to implement any strategy in your live accounts, please talk to your risk experts first. Please talk to your investment consultants, or talk to us first before you implement it. So today, without delaying any further, we're going to discuss about ETFs and what ETFs actually are, exchange traded fund, as we call it. Uh, if you even see, a lot of times, ETFs is not something which is a very new concept. I mean, the concept is actually really old now, and a lot of people, they trade in ETFs, they buy ETFs, they hold on to it, and it's not very different from mutual funds, because the concept is same, but then there are a few differences which we'll also highlight. So exchange traded fund is basically group of shares put together, and this is something which would track an underlying index. So ETF is also a group of securities put together, and that tracks an underlying index. So this contains investments mostly such as stocks and bonds. So for example, if there is an index called S&P 500, exchange traded fund can be formed which can track the performance of S&P 500 by employing all those 500 companies in their fund. And then investors can actually buy and sell that ETF, which has been tracking the S&P 500 index, right? And they are a very popular choice for investors which are looking for exposure to the overall stock market, and they want to diversify also. So consider ETF more like a mixed basket of investment, right? You talk about, so sorry, if we see, for example, we call it exchange traded fund. And guys, again, if you have any questions, please make sure that you use your chat options or Q&A options to ask if you have any questions, or if you have any doubts. Please do make sure that you are able to understand and ask questions. So as I said, exchange traded fund, or ETFs as we call it, so it's a very mixed basket of investments. Now that can include stocks also, commodities also, bonds also, and this ETF will be listed and it will be traded on exchange, and they are made of multiple assets. So one good part is you get a lot of diversification, right? Because if you see an index moves up and down, but in index also we see there are a lot of companies, and those companies have different industries. So you anyways get a different diversification when you invest in an index. And similarly, these ETFs, they track index, and you can buy and sell ETF also. They trade very close to their net asset value, which is basically the price of the ETF. And you can do this in a very cost effective manner. There are a lot of benefits, of course, in this, in terms of volatility, in terms of exchange. Let's read what we have here. Bought and sold like a common share on a stock exchange, right? Like a stock, ETFs are traded, and the experience price changes throughout the day. So you will see a buy and sell. You can buy and sell ETF throughout the day. And ETF generally holds a collection of stocks, bonds, and other securities in one fund, or have the exposure to a single stock or bond through a single security ETF. So there are a lot of single security funds, but here we are going to be talking more about the diversification part, where you can take exposure into multiple asset classes put together. Now, why invest in ETFs? This is also one of the most important parts, right? Why would we invest in an exchange traded fund? So you're looking for now tax efficiency is one of those things where we put ETFs primarily, but since we are all UAE residents over here, anyways, whatever investments we do are tax efficient. So that part, obviously, if you are a US citizen, even then trading in ETFs would be more tax efficient to you than mutual fund. So this is for all those people who are US citizens by any chance. So for you also, if you are trading in US, most tax efficient way will be exchange traded fund rather than a mutual fund, right? Now, looking at the diversification level, ETFs let you access a diverse mix of asset classes, and that includes domestic and international stocks, bonds, and commodities, right? Because when you are buying a ETF, you will see, we'll go through a couple of ETFs and we have a portfolio to discuss also. And you will see that a exchange traded fund will allow you to invest into a very diverse mix of asset classes. So from those companies which gives you good dividends, so there is a ETF for that. Those companies which are into semiconductors, those companies which are tracking, which are part of S&P 500. So ETFs are made for different companies. Lower cost, obviously. ETFs typically have a lower operating cost as compared to mutual funds, or act because a mutual fund has a more active manager, so the cost added to a mutual fund is higher. But as compared to ETF, ETFs are much more lower in the cost. Trading flexibility, you can buy and sell ETF using an online platform. You don't need to speak to a fund manager to get your trades executed, and that's one of the most beneficial part about investing in ETFs. Now, while we speak about mutual funds, if we were to understand the difference between mutual funds and ETFs, like how are they managed, how are they traded, what's the minimum investment like, what is the cost, tax efficiency, etc. So if you see, ETFs can be actively, very passively managed by the fund managers. Most of the ETFs are very passive because the investment is basically connected to the performance of a particular index. So if there is a S&P 500 index, the S&P 500 ETF would very closely replicate the returns of the index itself. So even if it is not actively managed, it could still give out the returns of an index. So that is one. Mutual funds, they come in both active and indexed, but most of the mutual funds are active. And active mutual funds, they're managed by fund managers, so they are more expensive because the active management cost gets added. ETFs would trade like stocks. You can buy and sell them on an online platform. You can buy and sell them on a stock exchange, and the prices would continue to change every day. So it's possible that when you're buying a ETF today, you can sell it today. Mutual fund, if you have to buy and sell, they're executed once per day with all the investors, and it happens on the same day, same price. So you cannot do multiple trades in a day in a mutual fund. And ETFs, because they are trade like stocks, they're made like stocks. There's no minimum investment. You can purchase one bit of ETF, you can buy a zero point 0.5 of ETF, and that is something which you can do right away using an online platform. Mutual funds, however, there are initial investments required. And again, as I said, mutual funds can also be purchased in fractional shares of fixed dollar amounts. ETFs can also be. If you use an online platform, you can buy fractional ETFs also. And at the same time, but it's more comfortable and more easier to trade into an ETF than compared to a mutual fund. Now, what we'll do is we'll go through some mutual fund ETF exchange traded fund portfolios to see that which are the ETFs which are going on in the market. And I'll tell you ETFs about stocks, about bonds, some exotic ETFs related to semiconductors. You can have a look at that also. And that's what we are going to do. And if we can also go through the live platform and see how easy it is to just buy or sell ETF on margins. So just allow me to share a portfolio with you. And meanwhile, if you have any questions and answers, please continue to write it. So there's a question right here. If I buy an ETF, will I end up buying from someone who previously bought it from someone else, like secondary market, or will I be adding my fund in overall AUM more like a mutual fund? So ETFs are traded like stocks. In fact, there are a lot of online platforms which provide you the liquidity. So mostly when you're buying ETFs, you're buying in a secondary market. So it's more of a buy and sell transaction. But in case of mutual funds, you definitely add your fund overall. So that's the basic difference. That's right. Okay, so now I'll share a portfolio with you, and we'll go through these different ETFs, and we'll just read about them. That which are these ETFs. So here, guys, let me just zoom this in so you can see the name of the ETFs as well. Yeah, this portfolio was made a few weeks ago, but the whole point of the today's session was to take you through the ETFs and make you understand and what it does and how normally it performs. So the first one is the SPDR S&P 500 ETF Trust. Now this is what does this fund basically do? If you see this right here, and again, if you want, you can ask for this portfolio as well from your relationship managers, and we'll continue to make more and more portfolios related to exchange traded funds, and you can always check this out. The SPDR S&P 500 ETF, uh, the trust. This provides you normally the objective of the fund, if you see, is to track the S&P 500 index, and this was established in 1993, has a $530 billion worth of assets. And if you see, the gross expense ratio of the fund is 0.09%, something which normally all the funds they provide. Now, one of the most important stock market index, as you can see and read, tracks the 500 largest US based companies. And again, the index has continued to grow. Uh, if you see, there were a lot of pullbacks in the US market. I think this was a portfolio which was made on last month itself, around 12th of August. And if you see, there were major pullbacks. A lot of investors and hedge funds, they shifted their focus from tech stocks to defensive sector. And this was something which happened last month. And after the July jobs report came out, which showed that the labor market was weakening. And if you see a lot, also this was also a reason that a lot of hedge funds, they unwinded their yen positions due to the rise in Japanese interest rates, and that was the day when markets fell a lot. So every single time when something like this happen and markets come down, a lot of investors, they see this as a good buying opportunity in the anticipation of the economic recovery. And this actually happened after a bigger fall of around 5 to 6%. We saw this index going really higher, right? And the ETF itself went higher in last 1 month. So this is the one which a lot of people can also do a systematic investment plan in. I think a lot of you have back in the past asked about that, how if I want to do an SIP in US market, which is the index which I should pick? And instead of the index, ETF will be a much better choice, because if you do it without leverage, you don't have to pay any holding cost on this. And if you do an index, mostly index are available in future contracts and they expire. If you take leverage in index, you have to pay a heavy holding cost. As per the current market scenario, the interest rates are still high. So using an ETF, if you go without leverage, it can really help you to create a systematic investment plan. First of all, for your child's education till he or she becomes 18 or 20 years old and starts going to college, you can just keep buying month on month a dedicated amount which can be put into a ETF like this. And there are a lot of more ETFs also, which by the way you can look into. But S&P 500 is one of the most important stock market index, because S&P 500 is the most important stock market index. There are 500 larger companies, and in August, as of August, we saw that the index went up by 22% year on year, and the earnings were really good that time for the companies. And after, even when the index fell down a lot, we saw a recovery happen in S&P 500, and that is why the ETF also have started moving higher. Just to give you a technical understanding of how the beginning of the year has been, if you see, this is the beginning of the year from here. And as you see, the slope is pretty much upward curving. Why? The reason is that eventually stock markets, the curve is always upward sloping, because the inflation kicks in and most of the companies pass on that cost to the consumer rather than cutting their profit margin, and that increases the revenue of the stock and thereby increases the stock price and thereby the index. So we have seen most of the time these indices are always upward sloping. That's why a lot of investors, they do systematic investment plans in index based funds, and you can do that too. And we can do a thorough research on this. We can tell you that which are these ETFs which you can look into, and what's the volatility for the downside, what's the yearly high, yearly low, and all of the other matrices. Just to give you an idea about the return analysis, 5 years return analysis, it's almost 100% up in last 5 years. In last 1 year, it was up around 21%. If you see the top holdings of the fund, maximum weightage is given to Apple, Microsoft, Nvidia, Amazon, Facebook, Google, then Berkshire Hathaway, Eli Lilly, Broadcom, these kind of companies. If you see by geographically how many companies are in it, mostly the geographical diversification is US. It's a US based index fund. And more weightage is given if you see the industries: internet, software, semiconductors, followed by computers, pharmaceuticals, then retail, banks, insurance, healthcare products. So a lot of diversification. Obviously, tech is something now which has ruled literally every index, so we can't keep tech away. But even in S&P 500 now, the top companies with highest market value are tech companies. So it's only uh, fair that most of the weightage is given to the tech companies. But that being said, there are other sectors like pharmas, retail, banks, insurance also, which allow you to take exposure in that stock. Right. Now, move on to the next ETF. These are some of the ETFs, guys, you guys can really look into. And as I said, of course, this is for information purposes. But even if you want to invest, you can do talk to your risk experts before you do that. But then the funds I'm giving you are the ones who are globally recognized. Invesco Triple Q Trust. This is the one which basically kind of mimics the performance of Nasdaq. As you see, performance of the Nasdaq 100 index is being tracked in this index, in this ETF, and it provides less diversification compared to S&P 500. This should be very clear. While S&P tracks a lot of companies and a lot of industries, including tech, this particular ETF takes more weightage towards Nasdaq. And if you see this particular ETF as compared to S&P 500, Invesco Triple Q is tracking the most fundamentally strong tech companies and which are operating in the area of AI, cloud computing, digital advertising space. This has been established in 1999. Asset under management around $270 billion. The index has outperformed majority of the indices. Now, this is really important. Why? Because tech has outperformed in 2023 a majority of the indices, and even in 2024, a tech rally continued to happen. But in the past, we have seen, in fact, in July, after the weaker job reports, we saw that Nasdaq did fall down around 7% due to the tech sell-off, which we were just reading about. And again, a lot of investors have felt that tech valuations are very stretched. Even now, also inflation data for US yesterday, it came down, like the inflation was less, which also reduced the possibility of central bank to lower the interest rates further. So this might be a blow to tech. I still feel that S&P 500 ETF is one of the most favorites at the moment. But if you want to take an exposure into tech companies, rather than picking one or two companies, it's better to take an exposure in a fund which is tracking the most fundamentally strong tech companies in the area of AI, cloud computing, and digital advertising. Right. It remains a robust and very influential index, Nasdaq, and the performance of major tech companies. We talk about economic, geopolitical uncertainties, which will continue to provide a lot of technology innovation based changes also. A lot of analysts are already bullish on this particular index because the tech companies, these are the ones which are very cash rich companies. So any fall in Nasdaq could be a good opportunity to buy this ETF also if you're planning a longer term exposure. Um, Again, as you see the graph, you see the downsides have occurred, but again, mostly always upward sloping. The two lines which you see here, the blue and the green, they're moving average lines, which means that if in the ETF also is flirting around the average, or I should say 50-day moving average of the prices. And for a longer term, so this is somebody just asked a question that is it something which we do daily speculative trades in, or is this something which we can buy and hold? A lot of investors, they use ETFs to mostly buy and hold. So the answer to your question is that you can use exchange traded funds for a long term investment, because a lot of times it happens that you want to invest into one stock. Instead of investing in one stock, why not take an exposure into a bunch of companies in a different sector? So that is something which you can do with the exchange traded funds, and you can buy and hold on to it for a long period of time. If you see this again, the top holdings of the fund: Apple, Microsoft, Nvidia, Facebook, Broadcom, Amazon, Tesla, Alphabet. It's a completely tech based index. And if you see the 5 year performance, while S&P grew by 100%, this shows the 5 year performance of 152% growth. And if you see the top industries, again, semiconductors, internet, software, computers, retail, biotech, auto manufacturers, telecommunications, 2.5% exposure to beverages also, and commercial services as well. But again, mostly the diversification is in US based stocks. So this is one of those indices which you can do. Third is the Russell 2000. Russell 2000, the Russell index is basically another name for a index called small cap in US. Small cap itself means the companies with smaller capitalization or smaller market value. There's a whole index in US which is based on tracking the performance of smaller market value companies, and it is called small cap index, and it goes by the name of Russell 2000. So there are 2000 companies in that index, and the performance of those is being tracked. Now there's an ETF which is created by iShares, and this tracks the investment results of Russell 2000 or the small cap index. Again, this was established in 2000, the year 2000, $63 billion in AUM. Small cap index rallied in July, August around 10%. And we saw a lot of S&P 500 based companies, they beat it profit estimates by smaller margins. But if you see the smaller market value companies, they have shown a better increase in Q2 profits. And this was something which was the highlighting factor for the small cap index, because if you see their PE ratios also, it was more favorable, and it seemed like the index was undervalued uh, year over year when we checked out. And a lot of these smaller value companies, if we see, they're more sensitive to interest rates. So if September rate cut happens and happens by a bigger margin, it might be good for smaller market value companies, because the smaller companies can borrow at a much cheaper rate to fund their operations. And again, a lot of investors are willing to take more risk as we see that if the economy starts growing. Small cap stocks are more appealing at the moment. As I said, the smaller market value companies are more sensitive to interest rate changes, and currently there is a area where we are expecting interest rate changes to happen, and the US elections are also coming in. So uh, you can also try the small cap index, and please remember this: the small cap index has it tracks the performance of the smaller market value companies, right? The index, and the ETF itself tracks the index. So by buying a ETF related to small cap, you are actually exposing yourself to the smaller market value companies of US. And it could be really volatile also, because these are the companies which are smaller market value, so they might be growing towards the mid cap or get become even better. But then the risk is also slightly higher when you're trading in a small cap index. Moving on, next ETF we are looking at. Look at this big fall which happened in small cap right here, and then again bouncing back. If you see the 5-year return analysis of the small cap index is around 48%. And if you see the top industry groups which are tracked under this index, it's banks, biotechnology, real estate investment trust, software, commercial services, healthcare, oil and gas. And if you see top 10 companies, Insmed, Farmers Market, Fluor Corp, all of these companies which have a smaller market value and belongs to different areas of real estates and biotech and healthcare products also. So you will get a much different diversification if you are investing into Russell ETF. Now moving on to a bond-based fund, which is also goes by the acronym name of TLT. So far, we have talked about stock-based ETFs. There are bond-based ETFs also, and as the name suggests, iShares 20 plus year Treasury bond ETFs. Now, this is basically designed to mirror the performance of the long-term US government bonds. TLT is a very large ETF, and it's very liquid. You can buy and sell this very easily on an online platform. And this is basically a fund which is mimicking the performance of the bonds which have a 20 years or plus maturity. We all know that how yesterday when we were conducting a session, we discussed about the fact that how long-term bonds are more sensitive to the interest rate changes. TLT is exactly the kind of ETF which you need to have right now in your portfolio. It ranks the fourth largest bond ETF, most significant long bond fund. Fund is composed of 99.5% investment grade bonds, and 15 to 20 years, 99% of them are 20 plus year bonds. Last we checked, the NAV was around 96 to $98. And good part about this is that there is always, um, you know, uh, not only you get a dividend or a coupon on these kind of ETFs, because there is a yield to maturity of 4.3%. And at the same time, if the interest rate goes down, the price of this ETF is also expected to go higher. So if the security is held till maturity, uh, which is the average duration around 16 and a half years, you will able to receive around 4.3% yield, and followed by if there is any capital appreciation over a period of time if the rate cuts become higher, because these are long term bonds, they are more sensitive to the interest rates. This ETF has achieved last 1 month return of 2.8%, 3 months is around 7.8, 12-month yield is around 3.7%, percent also. Those who are expecting how to work with Fed rate cuts, I think this is one of the better instrument to invest in. If you see right now here, look at this. Most of the weightage is giving to the bonds which are 20 plus year maturity. Now, if you see last 5 years performance of this ETF, it's down by 24%. Because to be fair, back in 2020 and even before that, bonds were not something which a lot of people would like to invest in terms of returns. In terms of safety, yes, but in terms of returns, no. So after the interest rates were increased, and we saw a lot of bond prices falling down. And now, when rate cuts are expected to happen, we might see prices of these ETFs also growing higher. So you can always, as I said, if you see in last 3 months, the ETF has grown by 7.8%, and this is a bond-based fund, so it's um, actually very good uh, return in terms of when you're looking at bond-based funds. Because a lot of my attendees would ask here that we not really know about how bonds work, and do we need a minimum amount to invest in, and you can actually do take an exposure in these kind of funds, and you can do using your online platform. It's very easy to buy and hold on to it, and if you take no leverage, you can just buy and hold on to this ETF without even paying any holding cost or without paying any leverage charges. And if the value of this bond ETF goes up, you can make some capital gains along with the if you hold on to it for enough period of time, you will receive some coupons and dividends also in this. So this is one of those investments. Again, you can diversify from stocks based ETFs to bond based ETFs. It's one of those total stocks bonds portfolio. Now, moving on to something exotic, guys. This is also my way to show you that ETFs are not only just in securities like stocks or bonds. It also can be about a specific theme like semiconductors. So iShares has created a semiconductor fund, which basically again has US listed equities, but mostly which are composed of semiconductor sector. And this was established in 2001. And now, as we see that semiconductors as an industry is expected to rebound, chip sales have started to recover in 2024. 2023 was a very slow year, but if you see the global chip sales are predicted now to reach $588 billion, which will be a 13% year on year increase, 2.5% higher than 2022's record breaking revenues. Memory chips, the industry's key driver, expected to reach 2022 levels of $130 billion in sales. AI chips for the market is very promising. Sales are predicted to exceed $50 billion for the year. So, again, if you see 80% of this ETF is allocated to semiconductors industry. If the AI rises as it seems to be, uh, this exposure in this particular ETF may not be the worst idea. Why? Because right now, when you are taking exposure in ETF, you are expecting one or two companies like sometimes Nvidia or Broadcom or any company which is into semiconductors. But you also know that this area is so vulnerable that if tomorrow the AI demand reduces, the tech stocks might start falling down. So instead of taking exposure in one company, it's always a good idea when these kind of exotic sectors we talk about, always a good idea to invest into a fund. Because in this case, if you see, uh, the top holdings: Broadcom, Nvidia, AMD, Qualcomm, Applied Materials, Taiwan Semiconductor Manufacturing Company, Texas Analog Devices. So, and if you see even geographical diversification, 85% is in US, 7.5% in Netherlands, 6% around in Taiwan, 0.9% in Swiss-based companies, and last 5 year return of this ETF has been on 239%. Year till date was up around 10.5%. Again, guys, in this case, it depends a lot on what happens to the AI in the future. The prospects are higher, so maybe the price which you see right now, you may not get it again. or maybe it comes down further. But that's why you diversify into these kind of different areas. Now, from equity based ETFs, we went to bond based ETFs. From bond based ETFs, we went to theme based, like semiconductor based ETFs. And now we come to commodity based ETF, a commodity based fund which is created by SPDR. And this is in gold. As we all know, gold prices today also have continued to show the highest. Today, gold has reached to its highest level, which is 2551, and continues to climb the new highs because at this point of time, I think the coming rate cuts and global uncertainties, it is only keep it will continue to keep the gold prices higher. And but the one fact also is that commodity directly gold, it moves a lot, 20-30 dollars in a day. So maybe if somebody doesn't want to speculate on gold prices but want to take an exposure still in gold, this could be an innovative way and a very cost efficient way to take exposure in the gold market. This is the fund which was established around 2004, has $66 billion in AUM. And as gold has rallied significantly, more than 14 to 15%, because central bank has started buying gold, a lot of retail investors in China, geopolitical tensions, global monetary expectations. So a lot of these reasons which have pushed gold prices higher. Even now also, there are a very strong fundamentals suggest that gold prices may continue to increase. And the Fed rate cuts, or if Trump becomes the president, that could serve as a further catalyst for higher gold prices in the second half of 2024. So, if you want to take exposure in gold and you don't want directly to do this in the commodity, you can take through SPDR gold ETFs and you can buy and hold on to these things. If you see the 5 year performance of this has been around 57%. But if you see last year till date, January to August, we saw the ETF growing up by 17.4%, and 1 year performance around 26.5%, and see the upward slope, obviously. So again, 100% weightage in gold in this case. And these are few ETFs you can definitely look at. Uh, Few of them, we talked about S&P 500, we talked about Invesco Triple Q. Even there are ETFs which are based on emerging markets, which I would like to show you one ETF which we haven't discussed today here, which is, yeah, this is iShares India 50 ETF. India obviously is a growing market, so we cannot be away from the emerging markets. There are China-based funds. There are a lot of these ETFs which are really important. But iShares India 50 ETF is one of those important funds also which you can diversify with. It's listed on Nasdaq and tracks the Nifty 50 index, which is composed of the 50 of the largest Indian equities. Indian economy is definitely projected to grow around 8% this year, and the momentum going forward 2025 and 2026 is higher. A lot of improved capital flows coming in, exports have been rebounding, consumer spending has increased, luxury products have also seen a rise due to rise in middle class income. Now, all of these factors are expected to benefit the luxury sector also. Indian financial sector is also expected to grow. And this is important because the energy sector is also expected to benefit from rising oil prices. So that is actually sometimes it impacts India a lot. And if the economic growth improves further, that could again increase the potential prospects of Indian economy also. So as an investor, you have a way to invest into this, because a lot of you who are sitting here in UAE, if you want to invest in Indian ETFs, you probably have to look at Indian brokers or your banks. Now, using an online platform, you can buy India ETF, which is dollar denominated. So you don't really have to do this from India and pay capital gain taxes to it. From a tax perspective, it will be better if you buy an ETF and take an exposure here. If you see last 1 month return or 3 months return around 5 to 7%, And if you see the holdings, top holdings are HDFC, Reliance, ICICI, Infosys, Larsen& Toubro, TCS, ITC, Bharti Airtel. And uh, as I said, majority of the exposure is in Indian markets. And if you see the industries, banks, oil and gas, and computers have the maximum weightage in terms of industry, followed by auto manufacturers, engineering, construction, agriculture, pharmaceuticals, and all of that. So, one exposure can be taken in that also. Uh, One question over here is asked, and again, very important. Please update on holding cost for long-term investments. See, right now the interest rates are high, 5%. Normally, the ETFs, if you buy, I'll tell you exactly what the holding cost appears right now on either one of these ETFs, and I'll give you a solution also instead of taking leverage and doing it. So let's say growth ETF, Vanguard, S&P 500, or so currently, as I expected, 7.3% a year if you buy and hold on to this ETF. 7.3%. There was a question asked that what is the holding cost? So holding cost is high because interest rates are pretty high at the moment. If interest rates cut or reduce, obviously the holding cost is also going to come down. But if you're a kind of obviously you're an investor who do not want to pay holding costs and wants to do it for a longer period of time, it actually would not make more sense for you to buy this on a non on a margin based or on a CFD account. You should do on a cash equities where there is no leverage and there's no holding cost charged. However, doing this on a margin account has its own benefits. You can take a leverage 2 or 3 times very easily on this. That would obviously increases your risk, but then again, you have both the options. Sometimes, if you find that markets have crashed and a ETF like S&P 500 growth ETF is it's looking uh, good and undervalued, you can actually take 2 or 3 times leverage, keeping a risk appetite in mind, and try to take advantage of that fall. If not, there is a way with Century itself you can have a non-leveraged exposure which will not uh, uh, bring any holding cost, or you will not be charged any holding cost for that. Another question here: if you buy ETF from Century Financial's platform, there will be charges in addition to the expense ratio of the ETF itself. See, if you buy from Century's platform, if it's a cash equities account, only commission is charged and nothing else. The rest, everything is just priced in the NAV of the ETF, which is mostly it depends on the market prices. So there is no extra account maintenance or AUM fee or any kind of other cost from us. If you buy the same ETF in a leveraged account using Century's platform, apart from commission and spreads, there will be a holding cost which will be charged to you. And as I said again, if you plan to hold on to this for a longer period of time, and normally a lot of traders do that and investors do that, they buy and hold on to it for a long period of time. It's better to do it in a non-leveraged account and do not pay the holding cost at this point, because the interest rates are high, so the holding cost is high. However, if you plan to do this in a non-leveraged account, the only charges which you pay is the spreads and commission, and that also is something which is not very much given the value of the ETF and the returns which we have observed. So this is something which is a very cost-effective way of you taking exposure. In fact, if you end up buying the same value worth index, it might cost you more in any other platform. So rather than the index, for a long-term perspective, you can take an exposure in the ETF, and that would be a more cost-effective way of doing this, right? Uh, a question has been asked here that can you tell some good investment ETFs apart from what we have discussed in 2024? See, there are a lot of them. Again, there are a lot of these companies like Invesco, ProShares, BlackRock, which have their ETFs also. But as I said, see, semiconductor ETFs, these are one of the few best performing ETFs in 2024. If you see a gold miners ETF, for example, or mid cap momentum based ETFs, a lot of these ETFs you can find on your product libraries. and it actually depends on how much is your risk exposure also, because there are funds which are there are ETFs which are based on US insurance companies. Then there are ETFs which have performed really well in terms of income, because there are few ETFs which are um, created for the way of by the way of generating more income. Tells you, like for example, uh, there are ETFs which are, as I said, there are single stock ETFs also, and the investment objective of these ETFs is basically to track the price of a specific stock, like Nvidia, for example. And there are some ETFs which would continue to give you a diversified exposure, like we talked about Invesco and semiconductors. And there are ETFs based on electric vehicles. There are ETFs based on energy. There's a fund called Energy Select Sector ETF, which gives you an exposure in major oil companies also. So that is that. There are some ETFs also, like dividend-based ETFs, which really gives you an exposure in all those companies which have a history of increasing their dividends. And there are a lot of these dividend based ETFs also, and you can easily buy and sell these. This is something which is created by Vanguard. These are created by iShares, SPDR, and these are available worldwide in different platforms. And you can always check. A lot of these in ETFs are based in US, UK. Some of them have a very good quality. Again, the dividends have been provided by these companies. So there are ETFs which you can buy, and those ETFs will give you an exposure to the companies which have a history of delivering dividends year on year, time on time, and they have a history of increasing dividends also. So this is something which also you can do. That being said, guys, thank you so much for attending today's session. ETFs is a very common form of investment, and a lot of long-term investors, they choose this mode of investment now because it's cost-effective, very tax-efficient, and easy to buy and sell. You don't need to have a separate fund manager to execute these trades. Talk to us more. We can create a lot of ETF portfolios for you and give it to you, and you can try to you know implement those trades in your accounts. But before, on the basis of this presentation, this was to make you more and more aware and informed, to get the latest updates and the pricing and the performance of these ETFs. Contact us and contact to our investment consultants. We provide consultants to all our clients, and the idea behind this is very simple: to keep the clients aware and informed about the financial markets and the coming opportunities. So once again, if you like this session, please go on Google Century Financial Reviews. Do give us reviews so that we continue to improve on this and continue to bring more sessions. As I've said before, September is a month where every single day we are doing a webinar. And we started with financial literacy. We moved on to fundamental analysis, behavioral finance, investor psychology, understanding technical analysis. Yesterday, we did a session on the European Central Bank and the impact of its decision. We talked about European bonds, talked about how to see the further rate cuts and how to interpret the ECB press conference. Similarly, today was about ETFs. Tomorrow, we are going to discuss about investment in change, in sustainability, in the areas which have been talked a lot about, mega trends, as we call it. And I'm sure you have heard these mega trends a lot. Tomorrow, we are going to discuss something very much related to those. So once again, thank you so much for joining this session. Please review us, and we'll see you tomorrow, same time, different topic. And you have a great night.